This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Holistic Survival Show with Jason Hartman. The economic storm brewing around the world is set to spill into all aspects of our lives. Are you prepared? Where are you going to turn for the critical life skills necessary to survive and prosper? The Holistic Survival Show is your family's insurance for a better life. Jason will teach you to think independently, to understand threats, and how to create the ultimate action plan. Sudden change or worst case scenario, you'll be ready. Welcome to Holistic Survival, your key resource for protecting the people, places, and profits you care about in uncertain times. Ladies and gentlemen, your host, Jason Hartman.
It is my pleasure to welcome Gretchen Morgenson to the show. She is a Pulitzer Prize award-winning journalist. She is currently with NBC, has a background with the New York Times, and she is the author of several books, including one that was very interesting to me, and I'm glad she came on the show to talk about it, and that is entitled, These Are the Plunderers: How Private Equity Runs and Wrecks America. Gretchen, welcome. How are you?
I'm good, Jason, and thanks for having me.
It's great to have you. So when we talk about private equity, there is so much that these private equity companies do. And I think this sort of came to the fore for the mass population when Mitt Romney was running for president. And, I think kind of some of the stuff they levied against Mitt wasn't really that fair, but, that's maybe another discussion. But, the private equity companies do a lot of stuff. They're involved in a lot of businesses, a lot of investments, and feel free to talk about those. But I'd like to definitely make sure we cover real estate, because a lot of single family homes are being purchased by private equity groups and similar Wall Street related groups. That has wide-reaching impact on what the prices of rents are, the prices of homes are, and so many other things. So Gretchen, I guess I'll just let you start by telling us what is sort of the overriding theme or thesis of the book.
Well, private equity, as you know, Jason, was what we used to call leveraged buyouts. And what that is it's a firm goes out and buys a company, uses a lot of debt to make the acquisition. The debt is amassed on the company itself, not the private equity firm. And then the private equity firm hopes to sell that company to another buyer in 5 to 7 years. And so they're looking to make it more efficient and more profitable so that they can get a higher price than they paid for it in 5 to 7 years. So we have two elements that are important there. One is the use of heavy debt, and the other is the quick turnaround time. And as an investor, that quick turnaround times can put a lot of pressure on a money manager, on anybody who's trying to perform, for their clients. So those are two pressure points that I think are really important to understand about where private equity is in the landscape of the investment world, and why in many cases that is an unsustainable business model.
Yeah. Well, is it unsustainable? Are you saying because it's too time pressured versus other businesses that aren't so time pressured?
It is that, but it's also the heavy debt. Okay. And we're seeing it right now, Jason, with the increase in interest rates. We are seeing far more bankruptcies than we've seen in recent years. And a lot of these are corporate bankruptcies that are leveraged companies that have been bought out by private equity and that have to now pay higher interest rates. Private equity uses debt that's floating rate debt. They don't use fixed rate debt. And so when interest rates rise, as we have seen, with the Federal Reserve being very proactive against inflation, the costs of these companies, the expenses go up. And that's what's really pushing a lot of companies to the edge, if not over the edge, into bankruptcy.
Okay, so one of the things, Gretchen, I'm always saying on my show that my listeners have literally dubbed the Jason Hartman question. Clearly, I did not invent the question, but it's compared to what? So give us a comparison so we understand, you said private equities use floating rate debt, not fixed rate debt. Is that because they're not issuing bonds for their purchase? That's the fixed rate debt of big corporations usually, right?
These are generally what's called leverage loans. And so those are traditionally floating rates. So yes. Also, don't forget, Jason, that these companies typically are not as well established and not as financially sound as, say, a very Fortune, 10 or S&P 50 company. And so they have to pay a higher interest rate to begin with because they are not quite as financially sound as another company might be. So, but it is going up. Their expenses associated with the debt are rising, and that is causing a lot of problems for investors.
So the other compared to what question is the size of the marketplace, just so people have some reference point. I mean, how big is the private equity world versus how big is the general world of Wall Street and publicly traded companies, or give us some kind of point of reference here.
It's interesting, and that's a great question, Jason. But, private equity is a very secretive industry. They don't put their name on the companies that they own necessarily. You don't know when you walk into a hospital emergency department that KKR runs it or Blackstone runs it. So it's very tricky to really get an aggregate number of how many companies. But we do know that 7% of the workforce, 7% of the U.S. workforce works for private equity companies. That's a lot. We also know that at least 40% of the nation's emergency departments are run by private equity. We know that at least 11% of the nation's nursing homes are owned by private equity. And so you see these kinds of numbers and you don't quite get the aggregate, but you get the sense.
Yeah. And one of the things I remember you talking about in the book is how they're so hyper focused on profitability that they come in and they cut wages and they decrease the standard of work, the working conditions of the staff. And they just you got to meet your numbers. You got to, it's like just this hyper focus on efficiency. But, it's sort of hard to criticize that really in the aggregate, Gretchen, because hey, that's business. Isn't that, the way businesses work? They have to work that way. And if they do work that way, don't they ultimately make the whole marketplace more competitive and bring a lower cost product to the consumer? I mean, this is up for debate. And, one of the areas where I would sort of disagree with my own question there, because I kind of think what I thought my answer was to that question, is now we're in this world where there's such a concentration of wealth at the top, where the CEOs of companies now earn hundreds of times what the rank and file workers earn. Whereas just a couple of decades ago, that was maybe they'd earn 80 times what the rank and file workers would get, not the minimum wage, the rank and file kind of middle workers. But now they're earning, 330 times. So how is that allowed to happen? And does it relate to private equity, or is that a separate issue?
Well, I think that the corporate CEOs and the ratio that the SEC requires companies now to put in their financial documents, which is very helpful. It does illustrate this problem of the real disparity in wealth between the workers and the management class. And to your question about efficiency, it's really a good one, and it is what their argument is. Their argument is we make companies more efficient. What's wrong with that? We then want to sell them for a profit. What's wrong with that? That's the American way. Plus, we work for public pensions, and so we're benefiting pensioners and public workers. So, but the question is, to what end are these efficiencies? How are these efficiencies affecting customers, affecting workers, affecting pensioners when they buy out a company's pension? So, just one example, I think, is very telling. And that is nursing homes. So if you look at nursing homes, and this was a study done in 2021 by very established academics at UPenn, University of Chicago, and NYU, and they found in a longitudinal study that nursing homes owned by private equity, residents of those homes experienced 10% greater mortality rates.
Yep, I remember reading that in the book.
Than non-private equity owned nursing homes. Okay, So you're talking about efficiencies that then translate to higher mortality rates. And the academics that did the study, I spoke with one, and she said, we found that what happened was they would cut staff. And that's why you had the mortality rate increase. It was that simple to them. They wouldn't make the investments in the properties, and they would, but most important, they cut staff. And so if you want to talk about efficiency, I am all for efficiency, but not the kind of efficiency that benefits the owner at the expense of other stakeholders, at the expense of the workers, the customers, the pensioners. And that's really the question here, Jason. Do we want the kind of capitalism that benefits a wide array of constituents?
Yep.
I think we do. Or do we want the kind of capitalism that only benefits a very, very narrow slice of the population?
So to give a little context on what Gretchen is talking about, context is important because really that sort of sea change in thinking started with who I think was a great economist, is Milton Friedman.
Right.
But, he also was the one who promoted this idea that the corporation has one sole mission only, and that is shareholder value, right? And, it became just too fierce, I think. It sounded good when he said it. In the context in which he lived, it was probably all right to say that. But it just became like so out of whack that we really have to understand, especially with the massive scale of some of these companies. And I'm looking at you, big tech, because you're just abusive beyond comprehension. These aren't really companies anymore. When a company has the revenue that is equivalent to the GDP of Ecuador, of many countries, it no longer gets the same privilege given by the 14th Amendment. Corporations are people, and they're not people. Okay, they don't go to jail.
I mean,
until they go to jail, they don't get the rights of people, in my opinion.
I would love to ask Milton Friedman about this because when he was operating, when he was writing, when he was researching, and I agree with you 100% on his bona fides. The CEOs of major American corporations were not making 400 and 500 and 1,000 times what their average worker was. It just was a different era.
Right.
And so while I understand the idea, it's very attractive to think that you can take one number and work on that number and help everyone. It really did not turn out to be that way.
Yeah, I know. I'm people are criticizing me, saying I'm starting to sound like a socialist, but, I just think that when a class of the population has become so insanely rich that there's literally nothing for them to spend their money on because nobody makes the interest. Nobody makes anything that good. Yeah, you can't even spend the interest on your money, right? You got to really question whether this is the way it should be, I
mean, if everyone were riding the wave and you didn't have this vast disparity between rich and poor in this country, if salaries had been going up commensurate with some of this in some fractional way, it would be different, but they haven't. And so you have this left behind, this enormous pool of people left behind, and this very tiny slice of the population doubling their money during COVID. I mean, it was just insane.
Yeah. Well, I hate to admit it, but I'm one of them. My net worth almost doubled during COVID.
I'm glad for you. I'm glad for you.
But no, I get it. I get what you're saying. Many of our listeners are real estate investors, and they're constantly talking about what private equity companies are doing in the real estate market. Are they going to buy up all the houses? RFK has, made that part of his platform. Tell us what they're doing in real estate, and especially in single family homes, but, feel free to talk about other real estate as well. What's your take on that?
Well, they have gotten very deeply involved in commercial real estate, as you know, and that is causing problems for anybody who's in commercial real estate because we have the, work from home population. And especially I see this in New York that, buildings are, 40% occupied or whatever. And those are that's not sustainable for people who own commercial real estate. So that's a big problem for everybody, not just private equity, for everybody right now. But private equity has gone, as you say, full force into single family homes and have really changed the environment in cities across the country. Small, medium, large cities have really changed the dynamics so that regular investors who mom and pop, smaller investors really are priced out of these markets. And first-time home buyers, honestly, are also priced out of these markets. And, we really do want, I think, to try to help other people gain the wealth creation that is a matter of course in real estate ownership. But if you've got these very wealthy, very high-powered, firms buying up all of these properties, you're really going to crowd out a lot of other investors.
Okay, so there's the crowding out effect because the private equity companies are bidding up the prices of the homes, right?
And buying them en masse and, entire neighborhoods, et cetera.
Okay, but here's where, like, are you sure about that? Because aren't these the same companies that we just were complaining that they're like hyper efficient and hyper focused on profit? Why would they overpay?
Well, they are not necessarily overpaying, but what I'm saying is they're crowding people out who might have a bid in the area, right? Who might want to make a bid on a property. Now, yes, they're paying more to make sure they get those properties out from under somebody else. But I think where they're doing their efficiency game is in not keeping up the properties and not maintaining them. This is what I've seen in a lot of my reporting. They also specialize in sort of gentrifying neighborhoods. And so what you find is the efficiencies are less about buying low and selling high and more about, we're not going to mow the lawn, we're not going to fix the pipes, we're not going to make sure the heat is operative in this apartment or this home.
Yeah, right. Okay.
And that's a problem for the renters. And, obviously, but often my research has shown that if these renters have nowhere to go, and so it's not like they can vote with their feet.
Yeah, right. So they sort of create, a semi-monopoly in a market, right?
Yeah.
And, if they have to pay $20,000 more, it's no big deal to them. That's like not even a rounding error for them versus a, typical home buyer. $20,000 is a big deal, right? On a first time buy. So that's the other thing. And, to answer my own question, they have so much capital to deploy that they've just got to deploy it. It's like a bulldozer. It just has to come through and just buy stuff. But where are they getting all the capital? Why do they have so much capital? How is it that investors have thrown so much money at them versus throwing that money at the other places they would normally invest?
Great question. So the oxygen that these firms need to exist comes from public pension funds, big, huge funds like CalPERS, CalSTRS, New York State Common, all of these massive pension funds that have huge liabilities, huge pension obligations to their past workers, to their current workers, and to future workers. And so what they have done in, say, I would say starting in 2000 area like that, a little bit, CalPERS was ahead of the curve going in the 90s, started to go full force into private equity investments, even though they're opaque, even though they're illiquid, meaning you can't sell relatively quickly, even though you don't really know the value because there's no market, quote unquote, for them. You can't see what the S&P 500 did yesterday and value your portfolio based on that. So all of those negatives, they poured money into them in spite of those problems and drawbacks. So you had a huge investment over the period of the last 25 years in private equity by public pension funds. And they were searching for yield. They were searching for returns that they needed because they've been underfunded for many, many years. Now, initially, those private equity funds did create alpha. They did generate outsized returns over and above what the pension funds were getting in stocks, in bonds, et cetera, in real estate even sometimes. However, now, Jason, very interesting, those returns have disappeared. Mm-hmm. And so the pension funds that are all in on private equity are now being faced with a diminishing return in the asset class, and they have to really start to think about what the implications are for their obligations going forward.
And can you give us some time reference points there? Like, when did the industry sort of gain so much traction? Like, many decades ago, I never heard of private equity. Where did it sort of come from? And then when did it get these great returns? And then when did the returns start to suffer? Like, give us some context timelines there.
So private equity is, as I said, what we used to call leveraged buyouts. And so they were...
So the 80s then?
The 80s. Yeah. So KKR is our, prime example, RJ Nabisco, that big deal. Of course, that was sort of the beginning.
Barbarians at the Gate book, by the way,
right.
folks, and the movie, if you haven't seen it.
Yeah. And so that was when it really became kind of a household word, but it was not private equity then. After leveraged buyouts kind of got a bad name, private equity decided they'd like to have a different name for their industry. And so they took on this kind of more genteel, name, private equity. So that's why you never heard of private equity in the 90s or the 2000s, because it was also called something else. In the early 2000s and before, actually, you really did have arbitrage possibilities here. Okay, so you remember in RJ or Nabisco, you had a period of time when stocks were in the doldrums. They were taking a beating. Nobody wanted to own stocks, right? All the way up until 1982. And so there was a big difference between the valuation that the market was putting on public companies and what those companies really were worth. And so the initial guys who were in this business were playing that arbitrage and doing it for a lot of money. Well, that continued in certain industries along the way through, like, say, 2010. And in healthcare was a big foray for them in the early 2000s. Because, of course, the nation spends 18% of GDP on healthcare. So, of course, it's a big, huge money pot. Yep. But it starts to diminish after the financial crisis of 2008. And so that's when you start to see the returns start to revert to the mean, revert to what you can get in an S&P 500 fund with a lot less opacity, a lot more liquidity, and low cost.
Yeah. Okay. Anything more you can share with us about the real estate market and your thoughts on how private equity will impact that market? Now, before you answer, I do want to say that even though RFK has sort of made a big deal about this, and a lot of people have, their impact is bigger than it's ever been. And I'll just sort of, categorize private equity with all institutional buyers of single family homes. The impact is bigger than ever, right? It's never been this big a thing. But compared to the overall market, it's really still not that big. Okay. But many think they want to just buy up every home in America, make America a renter nation. You hear RFK parrot those kind of phrases, which I think are a little overkill. But, do you really think that's true, Gretchen? I mean, do they want to buy up every home in America? Could they buy up every home in America? And what would that mean?
I think they only want to buy up the homes in America that really look to them to be undervalued and or a real opportunity for profit. Obviously, they're not buying up enormous numbers of apartments in New York City that are, very high priced. Right. What they'll do is they'll go and buy middle income and lower income neighborhoods and really sort of take those over because there's just a bigger play, I think, for profit there for them. But what is going to happen? It's very interesting. And I wish I had a crystal ball, but we can for certain say that the rise in interest rates is having a negative impact on the private equity business model, and especially in the real estate model. So you have much higher rates to borrow, and that just always translates to higher costs as an investor. So I think it's probably slowing down even as we speak, Jason. And so I think that you're really going to start to see, especially in commercial real estate, and we have seen it, some of these companies giving back the keys to properties where they're really sucking wind and pondering death.
So, I mean, that's mostly on the office buildings, and we've seen that, and it's starting to, there's some real pain in the multifamily apartment market as well. But in the single family home market, the opposite, these groups seem to be very good at just getting hyper focused on rents and using rental management software algorithms. Yes. In fact, there's a lawsuit about that, which is kind of a fascinating lawsuit right now, that's saying it's discriminatory. And I don't know if it is or not. They're saying the algorithm's discriminatory of how it makes the rent increases. But it seems like this is all going to lead to much higher rents because mom and pop landlords are notoriously bad at raising rents. They just kind of get very lazy about it. The tenant's pretty good. They don't bother me too much. I'll keep it the same. But I tell you, if anybody's ever lived in an institutional apartment or institutional single family home, every chance they get, they're going to raise the rent. They're going to nickel and dime you. They're going to have all these complex schemes. If you don't renew, if you go month to month, the rent's much higher. If you renew for 3 months or 6 months or 9 months or a year or 2 years, there's all these different pricing structures. This is stuff only a sophisticated piece of computer software and financial engineers could even figure out.
Absolutely.
But and they're good at maximizing that income.
the junk fees that are associated with this. I mean, if you're 5 minutes late with your payment, you can only pay through the portal, and then the portal goes down, and then you're late, and then they charge you a fee. There's, fees for garbage collection. There's fees for this. So
it's just like being a homeowner.
Exactly. Exactly. So, if I were to bet, and I could be dead wrong, and you can invite me back in a year and I'll say, mea culpa, I was wrong. But, we are in a period now with 8% mortgage rates. Okay. So individuals cannot afford that, can't afford to buy homes, right? New home purchases have ground to a halt, in the individual market. So this is a moment when these firms with all the capital that they have can continue to buy where others can't. So I have a feeling that they're really probably continuing full force in this area because they don't have any competition, or they have so much less competition than they would if mortgage rates were at 4 or even 4.5. And so it could be that this period enables them to take on far more properties than otherwise might have been the case. And Gretchen, then one of the we'll things, see about your prediction on how it turns out for them.
Yeah, I think we're seeing much more upward pressure on rents due to these companies, because if they own hundreds and hundreds of homes in a given sort of couple of neighborhoods, if anybody wants to live there, they're just going to bounce around from one of their houses to another, and they can, they've got a semi-monopoly.
The other thing that I wanted to mention is that in my reporting about this in several cities, I've noticed that these firms figure it's a cost of doing business when they get in trouble with the local housing officials. For instance, if a local housing group comes in and says, and I'm talking about, the city officials, not, an individual group, but city officials come and say, okay, you're not mowing your lawn, you're not fixing the pipes, they're happy to pay the fees because they're minimal. They are minimal as far as their cost of doing business is concerned. And so when they do finally have to pay the piper, it's really not a lot of money.
Yeah, well, the other thing they do is they have the power to lobby the government and to get things changed in their favor, which the mom and pop landlords don't have that power. So yeah, it's interesting too. But what I was going to ask you is, we started off, Gretchen, talking about how LBOs or leveraged buyouts work, where they saddle the company with a bunch of debt and then they pay the debt back through the company's own cash flow, which is really a phenomenal deal if you can get it. But how are they financing the single family home purchases? They're not getting individual loans on each property, right?
No.
What are they doing?
They would be raising capital from, again, these big institutional investors. And then they would have that pool of capital, and they would go in and try to be as efficient as possible to find a vast number of houses in, say, Nashville, Tennessee, or Cincinnati, Ohio,
or Atlanta, or whatever.
You name it. Yeah. And so, no, they are not doing it one mortgage at a time.
So what is the cost of their debt, and what are the terms? What do they look like? Do you know that? Are you aware of the cost of their debt?
Right. So it depends on the balance sheet, right? Are they very, very sound financially? If so, then, they could probably get capital, in the 7-8 range. If they're not sound, if they're really levered, then you're going to be talking double digits, right?
And how long? I mean, they're not getting 30-year fixed rate loans.
No.
What do the terms look like? Do they have 5 years, 7 years on those loans, or what?
Generally with private equity, the holding period is like 7 to 10 years.
Yeah. Okay. Interesting. Well, anything else you want to tell us? Any questions I didn't ask you that you want to share with listeners?
Well, I think it's just important, again, to go back to that question that you mentioned, Milton Friedman, and what kind of capitalism do we want to have? And, it's one thing to have an idea that you want to get rich, and I am certainly for that, and I am on board, but, at the expense of whom? And so that's really the question that I think we as a people really want to ask. And so if you're benefiting the vast number of people, if you're benefiting your workers and your customers and your pensioners, et cetera, then great, go to town. I wish you the best. But if you're penalizing all of those people to make money for yourself, then that's a problem.
Yeah. I mean, that's the whole idea of capitalism, is that it creates all these win-win relationships
Right.
where people where free actors, hopefully rational actors in a marketplace, trade value because, hey, look, the thing you have is more important to me than the money I have. So I'm going to give you my money and you're going to give me your thing, right? And that works until you get either crony capitalism or monopolies and duopolies or lobbyists.
Yeah.
or
Right.
or a technocracy, right? All of those
Yeah.
things really kind of circumvent that free market and what we thought capitalism was, and worked pretty well for a long time. But
That's right.
now you can see why it's not really capitalism in the typical sense anymore. Gretchen, any closing remarks, and give out your website?
Well,
Tell people where they can find you.
I don't have a website, but I will say this, Jason. Tell your investors that private equity is coming for their money now.
Mm-hmm.
Because they have tapped out all the pension funds. The pension funds can't put any more money in. They are up to here in private equity. And so you'll see little stories here and there about trying to raise money from individuals, trying to raise money from high net worth individuals. Be careful out there, because these people don't have your interests at heart necessarily. They might sometimes, but be careful. Read the documents. Make sure you understand the illiquidity. Make sure you understand the costs. Make sure you understand the other negatives. But they are coming for the individual investor next, because they need a new pool of capital.
Yeah. And Gretchen, a question I actually wanted to ask you earlier, about the pension funds.
Yes.
We are on the verge of a pension crisis, not just in the US, but worldwide, that I don't think anybody really understands the magnitude of how significant this is. And, if you have these private equity groups that are investing that pension money, and they're just in it for, their gain, the short term, and, they're going to cash out, they're going to take a huge percentage of the deal. Are they going to manage those pension funds responsibly? I'm guessing what your answer is, but, any thoughts on that and what that's going to mean to people?
They, like Friedman, believe that if they do the returns properly, that's all their obligation is, right? And so to the degree that they can beat the, benchmark, yes, they're going to be helping those pensions out. However, I would say this to your question, which is, I agree 100%, this enormous, real huge obligation out there that we are not going to be able to pay. The scariest thing involving private equity and pension obligations to me is that these firms are now going into the insurance business, and they are funding annuities and buying pension obligations from major corporations and managing those. And that scares me, because these are real risk takers. And I don't think the pensioners begin to understand what the risks are involved.
Yeah, I think you're right. Gretchen, thank you so much. The book and your other great books are available in all the usual places, of course.
Yep.
This one is These Are the Plunderers, How Private Equity Runs and Wrecks America, as well as your other great books, too. Thank you so much for joining us.
Thank you, Jason, and good luck to all your listeners.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.